All right, Scott Shellady is a manager of fixed income securities at XFA Futures. He's at the CME Group in Chicago. And here with us in New York, normally in Chicago, Linn Ellis, Chief Investment Officer of Strategic Financial Group. He's the author of a recent report called Recovery at Risk, and he is still bearish, Lincoln, as this market continues to march up. We're getting close to the pre-Lehman Brothers levels. The market's doubled since March of 2009. Why are you still bearish?
Well, I don't know that we're so much bearish, but I think we certainly didn't anticipate the heightened level of government involvement throughout the economy in the developed economies across the year. And I think that is our concern as we go into 2011, the extent to which that continues to push equity valuations and whether or not we get that multiple expansion that many on the street are looking for.
You say you underestimated the power of politics to prevail over policy / long-term vision / common sense. What has to happen for common sense to prevail? I mean, do we have to hit rock bottom? Does everything have to really just fall apart?
No, but I think we do have to face the long-term structural implications of both our monetary and fiscal policy and the structural implications of our unemployment situation. And unless we address those two issues, other exogenous factors are going to come back to bite us hard in the long term. But certainly near term, you've got to be bullish on equities.
So you are bullish on equities right now?
Because the government has once again stepped in. No doubt about it. Last Monday was a game changer. You have to up your GDP forecast. You have to up
PIMCO's been raising
your
its
multiple
forecast.
Expansion. You have to be there.
Why? Because of the payroll tax holiday. I mean, you knew the tax cut extension was going to come, right?
Exactly. But the payroll tax holiday really is a game changer, both in terms of reducing consumer credit, which, as our friend Dan Alpert has written recently, helps expand that consumer consumption.
Although Dan expects consumers to stop spending. I mean, it's been a good retail season, the good holiday season. He expects that to
in a cyclical
curtail
fashion.
in the first quarter.
And Scott, I want to send one out to you. I mean, we've had a nice move on the S&P since that August low here. What do you make in terms of the moves and also the shrugging off, it seems, of investors of all this insider trading stuff?
Well, I think that we've had a decent move up in the equities over the last 6 months, and I think it's been largely non-participatory. We had some people liquidate earlier in the year, get nervous after the May 6th or May 5th flash crash that we had. So I think that although the market's done very well, I don't think a lot of people have benefited, number one. Number two, also the sovereign debt crisis over in Europe's made our economy look less ugly. So I think that with what's going on over there, suddenly we don't look like the ugly stepsister anymore, and we've had some decent news come out, which I would also say is less mediocre. So while I think that we're going to get a short-term boost about what's going on right now and what we may happen tomorrow in the S&Ps, I think that our target was still 1225 to 50 on the S&Ps. We failed at those highs earlier today. I think that we probably stick in that level anyway, but I think that my 3-month outlook is I think that we're going to get a boost from this economy. These numbers are coming in slightly better than we thought. However, I think that with the game changer that the government gave us a week ago, I'm worried about what happens in 6 months, 8 months, 9 months down the road. So I think the third and fourth quarter next year, we've got some serious issues on our hands.
Well, it's funny that you say that because 6 months down the road from here, Jeremy Siegel, we talked to him yesterday. He's very upbeat about the outlook, and he actually says the Fed's going to have to start raising rates sooner than everybody expects. Listen to this, everybody.
They're going to have to reverse their policy stance faster than they now anticipate, because I think they're going to see momentum in 2011 faster. Long rates are going to rise. The long bond is going to finally tell them, hey, zero interest rate short-term policy no longer appropriate. A lot of people are talking about 12, 18 months. It's not going to be that long.
And Lincoln, he actually thinks maybe in about 6 months from now, because see the Fed start to reverse action. If we get that, what happens to the market in your view?
Well, look, if the last 2 weeks are any indication, the market's going to raise rates for the Fed well ahead of even the 6-month window. And so
the market will be okay with it then?
Well, Adams actually pointed out in yesterday's broadcast that in fact the markets tend to take that as a positive sign that growth is actually occurring and that this is tamping down on inflation. We don't believe that at all. We think there are huge.
But it's closely correlated, as Adam pointed out.
They are closely correlated, except in deflationary environments. So continue to watch the PPI, continue to watch the CPI, the core components of both the Empire Fed and the Philly Fed, to see the employment and how it actually unfolds as to whether or not both consumers will have the dollars to deal with pricing increases that could potentially be down the road, and you either get margin expansion or you get margin contraction in the inability to pass that on.
You know, before we go further down the inflation road, I want to ask Scott what he thinks about Jeremy's comments. Do you think it's likely, is even a possibility that the Fed raises rates in 2011, and how would the market react?
Well, you know, we're all about this self-fulfilling prophecy. You know, it wasn't that long ago that things weren't that good here. And like I said earlier, all of a sudden we have the European sovereign debt crisis, and America doesn't look as ugly as it used to.
Dirty shirt.
I think that Right. So all of a sudden, the calls for the 10-year to go to 4%, we go from 2.5% to 3.5% in a 5 or 6 week period of time. That's a major, major move. We are now talking about self-fulfilling prophecy. So everything that's come out that I've seen, except for the non-farm payroll number, has just been slightly better than expected. Nothing's ripped my face off except for what the government gave us a week ago. But what the government gave us a week ago, there weren't any spending cuts. So I think that we have some issues going into the last half of the year, only because I'm not sure how we're going to pay for what the government gave us, number one, and our problems here, housing and unemployment's on life support, those two issues aren't going away very soon.
Hey, Scott, it's Dominic here. One of the things that we were looking at before, back early in the spring, 4% was that level that everybody jumped in and said they wanted to buy 10-year treasuries, right? Now some 30-year muni bonds are getting up to like almost 5% here. At what level do you think people are going to step back in and say, hey, the yield's just too good to pass up?
I'm already seeing our desk is lighting up with people thinking that now. Because, you know, there's a little bit of Kool-Aid going around the market. And believe me, I'm the most positive guy out there. However, I'd like to try to, you know, temper that with a little realism. It wasn't that long ago that things didn't look that good here. You remember how we were going into that QE2 announcement? We're going to have 0% interest rates until I die. Well, now we've seen a couple of things happen over in Europe. The U.S. doesn't look so bad. We've had some numbers come out that were less mediocre. I mean, nothing's ripped my face off. And the non-farm payroll number was bad, by the way, but everybody's discounting that, too. So I think that the yields now, these might be good yields in 18 months' time when we all think, boy, we should have done something.
Lincoln, any quick thoughts about tomorrow? I mean, we've seen such a nice trend up here. I know you don't maybe think it's so nice, but I mean, do you see any reason that this is going to run out of steam?
Yeah, I mean, look, I expect that there's three of them. Interest rates backing up, that's one.
But not in the near term.
The steepness, not in the near term. The steepness of the rate of change that we've seen since the September rally. And then thirdly, we haven't yet unveiled the full EU liquidity blanket that will be EU TARP once Spain continues to find itself downgrading.
Yes, exactly. We got to run. Lincoln Ellis, thank you so much. Scott Shellady out there in Chicago, thanks to you as well.